All right. Week 5, understanding a firm's financial statements. So this week we're going to talk about what are financial statements, why they're important, and also how to create financial statements. So we'll be talking about that this week here in the Small Business Management class. Setting up the business. So one thing we want to talk about is a balance sheet. A balance sheet is a picture of a firm's assets and its sources of financing at a point in time, whether it's the owners putting money into the business or from borrowing money. Money put in by owners is also considered equity. Balance sheet example. Initial balance sheet, assets. Cash, $50, so therefore you have a total assets of $50. But when you look over here, you'll see loans, which is also debt and owner's equity. So if you have $40, so for example, if I start a business and I got $50 in cash. So I got $50 in cash. Well, how did I get that $50 in cash? Well, let's say if I took out a loan from my mother. If I took out a loan from my mother gave me $40 and I had $10, that's what I put in. So my total loans and equity is $50, which is total asset is $50. All right, continue, a balance sheet with supplies. So now with that $50, I'm actually buying inventory, I'm buying supplies. So as you see, now you look at assets, as you remember on the other sheet, we had a total of $50 in total assets, we had cash, but we took a loan out and got it. Well, now I'm spending $40 on supplies, which is my inventory. So that leaves me with a total of $10 plus $40 worth of inventory, which my total assets is $50. Now, going over here, loans still pretty much stays the same. Loans, $50, owner's equity 10, total loans equity is $50. Only thing that changed was the amount of money that I spent on supplies, which became my inventory, $40, which I'm going to try to make money off of that. All right, what is an income statement? Income statements show the results of business operations over a certain period of time, i.e., let's say sales, 60 items times $1 times $1 per item sales price. Cost of items sold, 60 items times 25 cent cost per item. Profits. So for instance, what this is this, you have $60, you sold 60 items at $1, but it costs 25 cents to make it. Now remember, you sold 60 items, so that's $15, so you have to subtract that. So what is your bottom line? What is your profit? Your profit is $45. Why? You sold 60 items at $1, which equals $60. And those 60, now it took you 25 cents to make those items, or that was the cost per item, which came to 15. So you subtract $60 minus 15, which gives you $45 in profits. Balance sheets containing income. Now that your business has income, it needs to be added into the balance sheet. Using the balance sheet example from before, the balance sheet will look like this. Cash, $40, accounts receivable, $30, inventory, $25, total assets, $95. So what you might say is, hold on, what about account receivable? Account receivable is money that you have coming in. So that means, for instance, if you sell goods and you don't get paid for it, but you already delivered the goods, you will put that in accounts receivable. So therefore, if I sold 30 items at $1 a piece, but I have not got paid for it, but the merchandise has already been delivered to the buyer, then I can put that in $30 receivable because I still have to collect on that, which turnaround brings my inventory to $25. So my total assets is $95. Loan still $40. I still got to pay off the loan for $40. Now my owner's equity is $55, which is $95. So then you will say, all right, you say account receivable and inventory, that's how they got the $55. We look at $30 plus 25 equals $55, so that's the owner's equity because you combine those two, accounts receivable and inventory. Accounts receivable. In the balance sheet example, accounts receivable is the amount of money not collected for items sold. Cash increased by $30 because that is the amount of money that was actually collected for items sold, resulting in 40 instead of 10. $15 of inventory was sold during the business day, causing the inventory to go down to $15, and equity increased by $45, which was the profits for the day. So what I want to focus on right now is, we're going to go back right here. Cash increased by $30 because that is the amount of money that was actually collected for items sold, resulting in $40 instead of $10. So going back to the original balance sheet, when we only had cash of $10, we made $30 that day, which actually increased it to $40. So $15 of inventory was sold during the business day, causing the inventory to go down from 15, and equity increased by 45. So our equity was at 30, but it increased by 15, which the 45 was the profit for the day. Accounts receivable continued. After collecting the accounts receivable, which is money customers owe the business, this is what the balance sheet will look like. Assets, cash $70, accounts receivable 0, inventory 25, total assets 95. The reason why account receivable is 0 because we don't have anything to collect on at this point. But now you see, it still has not changed. Loans $40, owner's equity 55, total loss of equity 95. So what we did here, we simply said our cash flow has increased because while we just in the previous slide before, we talked about we made $30. We talked about how we made $30. So if you go back right here, cash increased by $30 because that's the amount of money that was actually collected for items sold. So therefore, when you look at it on a balance sheet, it is what? It is 0 because we collected on it. So now our inventory is at 25. So now our cash increased from $40. We add that 30 we collected in accounts receivable to actual cash. That's 70. Now 70 minus 25 gives us a total assets of 95, which still puts this owner's equity at 95. Because now you just, instead of, earlier I know we did accounts receivable minus inventory, now we're saying cash minus inventory equals owner's equity. And as you see, it balances out. The balance sheet, when something has to be balanced, it has to be level, right? On your left side, total assets 95. Your right side, loans, debt, owner's equity 95. So that means your balance sheet is zeroed out. Income statements. Income statements reports financial information related to 5 broad areas of business activity. Sales, which is revenue, how much have you made in sales? Also, number 2, cost of producing or acquiring the goods or services sold by the company. Number 3, operating expenses. Number 4, interest expense. Number 5, tax payment. Going to number 2, cost of producing or acquiring the goods or services sold by the company. So either you're going to produce it or you're going to acquire the services. So if you're into the shoe retail business, how much does it cost to produce these shoes? How much does it cost to produce a pair of shoes? That's what that would be number 2. That's what they're referring to. Or when they say acquiring the goods, if you buy the goods and then you resell them. So therefore, you might not produce your own shoes. You might go to an actual buyer and buy the shoes from a buyer, and then you might add your price on it. So that's also goes into that's also what's called acquiring the goods or services sold by the company. Number 3, operating expenses. How much does it cost for you to do business? You know, marketing, payroll, a lot of different goes into operating expenses. All right, interest expense. If you take out a loan, and then you have an interest payment. So how much? So that's what they mean by interest expense. And then with tax payment, you have to pay taxes. You have to pay your business taxes. You can do it quarterly, or you can do it semi-annually, or you can do it year. All depends on what type of business you're in, and also the year of your business.
Take a break. All right.
Income statement continued. An income statement or profit and loss statement indicates the amount of profits generated by a firm over a given time period, usually monthly, quarterly, or yearly. Income statements all follow this basic formula. Sales, which is the revenue, which we talked about earlier, minus expenses equals profit. How much money did you make? How much money did you make, whether it's monthly, quarterly, or yearly, minus your expenses? So, for example, if you made $100,000 in sales selling shoes in one month, what is your expenses? If your expenses include marketing, payroll, etc., and also the cost of doing business, also the cost of production of buying those or acquiring those shoes was $60,000, then therefore your profit is going to be $40,000. Why? Because you had $100,000 of sales in shoes, but the cost of your expenses was $40,000. So that equals your profit, which is your income, is what? Is 100,000 minus 60,000 equals $40,000 in profits. All right. What do we have here? I'm going to make this a little larger. Income statement depth. As you can see, there is more to income statements than just that simple equation. Remember that positive net profits in an income statement does not necessarily mean that a firm has generated positive cash flow, which later we'll talk about a cash flow statement. But sales revenue minus cost of goods, cost of producing or acquiring product or services to be sold equals gross profit. Now, once you get your gross profit, you got to look at your operating expenses. Marketing, selling, general, administrative, and depreciation expenses equals operating profits. So, earnings before interest and taxes minus interest expense, cost of borrowing money. So, so let's look at this. Sales. We had $850,000 in sales. Also, now the cost of goods sold was $550,000. Gross profits was $300,000. Now we're going to break down operating expenses. Marketing expenses was $90,000. General and administrative expenses was $80,000. So when we talk about administrative expenses, we're also talking about, I pay. That's what you're talking about. Payroll, payroll, also paying into insurance. Now depreciation, that's of the equipment that we have bought. So our yearly depreciation of all the equipment totaled $30,000, which makes the total operation expenses $200,000. So operating profit, $100,000. Interest expense, if you look over here, interest expense, $20,000. So if we have operating profits of $100,000, but our interest expense is $20,000, so profits before tax is $80,000. Now, $80,000, because once again, we're coming from $300,000. So $300,000 minus $200,000 gave us $100,000. Now we're subtracting interest expense to cost on that loan was $200,000. So you look at it, profits before tax is $80,000. Now income tax is 25%. So on that 25%, we got a net profit of $60,000. So we're not gonna. So our net profit is $60,000. Now dividends paid. That means we'll talk a little bit more in depth later in this class. Dividends is retaining to like stocks, or actually, or paying out to like stocks. How much you have to pay out for people that invested in us. Change in return earnings, $45,000. So great. We made $850,000, but at the end, after all is paid, our real income is $45,000. And I'm going to shrink it so we can read the bottom, which is said this is an example of what a real income statement would look like following the formula from the previous slide. So the formula that we're referring to would be this one right here. Income statement, as you can see, there is more to income statement than just simple equate than just that. Actually, we're going to go back 2 slides. I apologize. Sales revenue minus expenses equals profit. So that's the equation that slide number 13 was referring to, which is this example of what a real income statement would look like following the formula from the previous slide, which we just looked at again. So we're going to move forward to slide 14. Key terms to remember for income statements. Depreciation expense is the cost of a firm's equipment building allocated over their useful life. Some people do 5 years for equipment, 10 years, 15, 20 years. So if you're going to use 5 years to depreciate, and you talk about later, we'll go back and talk about the straight line method. You know, when using the straight line method, if you're going to do depreciation over 5 years, you're going to use 20%. But we'll go back and review at the end of the more later. All right, net profits. Net profits are the profits that the business earned for its owners after paying all expenses, including income tax. Once again, net profits, which is your real profits, are the profits that the business earned for its owners after paying all expenses, including income tax. How many times have you heard people say, man, I profited $300,000. Great, that was your gross profit. But after you pay income taxes, you have to subtract how much it costs to doing business, your marketing, your payroll. You look at it, and they made $100,000 that year. So this is important for when you get ready to maybe acquire a business or invest in a business. You want to look at the bottom line. The bottom line is the net profit. That's what you want to look at on those income statements. Now, we're going to move on to dividends paid to a firm's owner, unlike interest expense, are not considered an expense in the income statement. Instead, they are viewed as a return of principal to the owners. As I stated earlier, the owners are the ones who have invested into the firm or company. So therefore, the dividends paid is what they agree, is the principal amount that they agree upon. And so therefore, that is the reason why we saw earlier in slide 13, I'm going to make it big, increase the size, while we had dividends paid was $15,000. So that's the reason why it dropped to 45, because the owners who had, or the shareholders who had ownership in this firm, they were due $15,000. Now, one of the good things is if you have a sole proprietorship, then you're not going to have to pay dividends. This is only when you have more than generally like one person. All right. While income statements reports the results of business operation over a period of time, a balance sheet provides a snapshot of a business financial position at a specific point in time. So what we're going to look at is assets, debts, equity, net worth. I'm going to make this a little bit larger. All right. So what we're looking at is assets, current assets, cash, accounts receivable, inventories, plus fixed assets, machinery and equipment, buildings, land, plus other assets, long-term investments, and then patents. So when all this falls up under asset. What they mean by patents, let's say if you created an idea, and you got a patent through the proper channels with the U.S. federal government, then therefore that is an asset because you can sell it. Assets is something that you can basically sell, or basically sell it to cash, or so long-term investments, you know what that is. Long-term investments could be, you could be investing in other companies and other business ventures. Land, you can sell land. Buildings, you can sell building. Machinery, equipment, you can sell building. Inventory, you can sell your inventory. Accounts receivable, you can even sell that out because you know that you're going to get paid. You know you're going to get paid in cash. Cash is just an asset because it's already cashed. Now, moving to debt, liabilities, and equity, your net worth. All right, debt. Current short-term debt, accounts payable, or current expenses, short-term notes, and I apologize for it being blurry. And long-term debt, long-term notes, and mortgages. Because guess what? You're paying out. Accounts payable, you have to pay out. Accrued expenses, you got to pay out. short-term notes. Short-term notes is like your monthly rent, your insurance. You have to pay that out. Long-term debt, your long-term notes, that's going on, maybe your long-term, not long-term debt, you have to pay that out. Mortgages, like I said earlier, you gotta pay that out. You put mortgages on the long-term debt because most likely if you own your building, now you're doing it like a 15-year, 10, 15, 20 year, or 30 year. So it's long-term. Now ownership equity, owner's net worth, how much are you worth? What is your net worth? Or partnership equity, or common stock equity. So that's just going over those whole. All right, 16. We're going to decrease it back. Current assets include those assets that are relatively liquid. That is assets that can be converted to cash relatively quickly. Fixed assets are the more permanent assets in a business, equipment, buildings, and land. Depreciable assets that decline in value over time. So eventually, your equipment building will become depreciable assets because it will depreciate over time, more than likely. Now, your current assets, let's go back and look at slide 15. You look at your current assets going to be your accounts receivable and inventories. Why accounts receivable? Because you got money coming in quickly, and also your inventory. You can sell your inventory, so that, as I said, converted to cash relatively quickly. Now moving on to 17. All right. Once again, we're talking about assets. So I'm going to say when a firm buys a truck, the original cost of $20,000 is shown on the balance sheet as a gross fixed asset. Each year, the cumulative depreciation expense, or what is called accumulated depreciation, is subtracted from the original cost to give the net fixed asset. So year one, we have $20,000. So we're thinking, if you look at this formula, what they said, okay, year one, we're only going to subtract $5,000, which is $15,000. Now you might be saying, well, why? Well, accumulated depreciation is how many years of using $5,000 does it take to what equal 20,000? It takes 4 years. So that's why you say year two, 20,000. You're going to subtract 10,000. So now the next bit now is only worth 10,000. Now you say, okay, I'm subtracting 10. It's only a $5,000 increase. You subtract 5, 15,000. Subtract 10, 10,000. Year three, another 5,000, 15,000. Now it's worth 5,000. And year number 4, that truck is worth what? It's worth 0. Because why? It takes 4 years at $5,000 a year to equal $20,000. So it bottoms out, it zeroes out in year number 4. So with the formula that they use is how many years does it take using $5,000? And you say, well, why did they use $5,000? Well, I can tell you the reason why they used $20,000. It looks like they did the 25%. So if you do 25%, if you say 25%, if you deduct 25% each year, it'll take 4 years to equal 0. Debt. Financing provided by a creditor. Accounts payable represents credit extended by suppliers to a firm when it is, or company when it's purchased inventory. Accrued expenses are expenses that have been incurred but not yet paid. So if you have, it could be something as simple as a marketing bill with the local. If it has not been paid, then it's an accrued expense because that expense is going to keep coming. It's going to keep coming weekly, monthly, until it's paid off. Equity. Ownership equity is the money that owners invest into a business. So earnings retained with the business. Ownership equity equals owner's investment plus cumulative profits equals cumulative dividends paid to owners. One of the most famous people who was great about doing that was the late Steve Jobs. Steve Jobs, if you don't know, Steve Jobs invested in a company called Pixar. And every time Pixar needed money, he would just come out of his pocket and invest. So before you know it, he ended up owning 100% of Pixar because he kept investing his own money into it. So this is a prime example. Ownership equity, his equity went from 70% to 100% in a matter of a couple of years. So owner's investment plus cumulative profit equals cumulative dividend. But the importance of this is this. Owner's equity is the money that owners invest in the business. The more money you invest in the business, the more part of that business, the more you should actually own. So therefore, when it comes time to give out the dividends or break down the profits, the more you own of that company, the more you will have. The cash flow statement, that's what we're going to talk about now. A cash flow statement is a financial report that shows the sources of a firm's cash and its uses of the cash. Accrual basis account. Profits are recorded when earned. Whether or not the profits have been received in cash and expenses are recorded when they are incurred, even if money has not actually been paid out. What this is basically saying is, hey, when it comes to accounting, you still going, even though you might not collect it on the money, you're still going to report it. Because why? It's eventually coming in. So, what it says, profits are recorded when earned, whether or not the profits have been received in cash, and expenses are recorded when they are incurred. So, whether or not you receive the cash, you know that they're coming. So, end of the year cash flow statements will look like this. So the net profit is $60,000 plus depreciation is $30,000. So profits before depreciation was $90,000. So this is your net. This is how much your operating expenses, everything else is $60,000. Plus now you also have depreciation. That's of your equipment, truck, etc. So you add that into that gives you $90,000 because you have to take away $30,000 because you're going to write that $30,000 off. Now, less increase in accounts receivable, uncollected sales. So you still have $5,000 that's out there that you need to collect on. Less payments for inventory consisting of increase in inventories, negative $40,000. Less increase in accounts payable, inventory purchase on credit. So here it is. You look at it. You got $5,000 right here because you haven't collected the sales. But that inventory. You have inventory purchase on credit for $5,000, so that's going to be a subtraction. But okay, increased inventories also is $40,000. Increase in inventory is $40,000. So your inventory has actually decreased to $40,000 based on how much you sold. Payments for inventory, $35,000. So you still have $35,000 inventory there. Cash flows from operations, $50,000. So we're going to slide down. So let's increase in gross fixed assets, negative $100,000. Financing activities, increase in short-term notes, $20,000. Increase in long-term debt, $50,000. So now you pay that $20,000. That's how much you pay. That was an increase, went up $20,000 into your short-term notes, which is money going out. Also, your long-term debt increased by $50,000. Less dividends paid to owners. So you actually paid $15,000 because these numbers are in singles. Financing cash flows $55,000, increase in cash $5,000. So at the end of the day, the increase in cash flow of the year from the previous year was $5,000. All right. Also, now we're going to talk about liquidity. Also, we're going to go over a couple of formulas that you're going to need for coursework that will be given out to you later in the week. So let's talk about this. Liquidity. A business or a person that has enough money to pay off any debt owed is described as being liquid. As we talked about earlier, liquid cash, that means you have right there on the spot, right money on the spot. You can pay off your debt, or you can pay your bills. The liquidity of a business depends on the available of cash to meet maturing debt obligations. The current ratio is traditionally used to measure a company's liquidity. This ratio compares a firm's current assets to its current liabilities. So your current rate, what is the current ratio of a company? You will use this, current assets divided by current liabilities. Liabilities is your debt, is your short-term notes, your long-term notes, your mortgage payment, etc. Now, let's talk about profitability of assets. Here, we're going to go over this ratio. A comparison of operating profits to total assets reveals the rate of return that is being earned on the entire firm's capital. We compute the return on asset as follows. Return on assets, you would use operating profits divided by total assets. As we talked earlier in the earlier slides, you know, profitability of assets continued. Return on assets equals operating profits equals operating profits times sales divided by total assets. So return on assets, first you would say operating profits divided by total assets equals operating profits divided by sales times sales divided by total assets. Sounds all confusion, sounds like it's all together, but here we're going to break it down. All right, operating profit margin, return on assets. If you're, what you get is, you say 11.76 times total asset turnover 0.92 equals 10.87. That's your return on assets. So I would give you actual problems so you can actually work it. Just remember, return on assets equals operating profits divided by total assets equals operating profits divided by sales times sales divided by total assets. So this week I will actually give you worksheets to where you can input actual numbers and use this actual formula, which will give you a percentage, And then return on assets is just another one. This one's just another formula. All right, moving on. The debt ratio tells us what percentage of the firm's assets is financed by debt and is computed as follows. Debt ratio equals total debt divided by total assets. So ever how much debt you have, you want to divide that by your total number of assets, and that'll give you your debt ratio. So it's kind of like on your credit report. They say they don't want you should be no more than 30%, 30% in debt. So this is, and they divide it by how much money you got coming in versus how much debt, how much money you owe creditors or people. Same scenario. How much do you owe, and how much do you owe, and how much do you have in assets? That's how you come up with the debt ratio. All right, return on equity. Well, a lot of people want to know is, if I'm going to invest in your firm or company, what is going to be my return? They want to know what is their hurdle rate going to be. The return on equity is the net profits divided by the total common equity shown in the balance sheet. So if your net profit is $60,000, so you say net profit divided by owner's equity, and we have these numbers. Let's say the owner's net profit was $60,000, but the owner had a total of $620,000 in equity. That equals a 9.6% return on equity. I think the common standard now is between 20% to low 30%. So I would not invest in a company where is my return on equity only going to be not 10%. But we'll go more, elaborate more on that. Also give you some worksheets to where you'll be able to plug in this, to see if it's a good plug in this formula and see if it's figure out the return on equity percentage. And that concludes the explanation of what we're going to do for this week.